After studying this module, we shall be able to know about deposit and lending of international bank, understand working of interest rate, that is LIBOR, learn about loan syndication. Introduction. Today, banks are becoming more international due to the widespread of multinational corporations across the globe. When a multinational corporation takes a decision to set up its subsidiaries in various countries, banks are also motivated to follow them to meet the needs of its foreign clients. As the banks are closely associated with the parent company and know about its financial transactions and operations very well, they are able to provide the required services in a better way to its clients. This gives them an advantage over other banks, and this advantage motivates them to go international. International banks offer high interest rate on deposits and charge lower interest rate on lending in comparison to domestic banks. This helps the banks in attracting the depositors and borrowers from domestic country as well as from other countries, which in turn gives an impetus to banks for going international. There are other factors that encouraged the emergence of international banking. For example, by opening a branch or representative office in foreign country, it is possible to collect economic, political, social and other information regarding economies. Another factor is the provision of custodial services to the clients who invest in foreign securities. These services include safekeeping of foreign securities, dividend collection and handling of stock splits, rights issue, tax reclamation and so on. Over the last 2 decades, significant changes have been witnessed in international banking. Technology and regulations influencing the operations of the banking system industry. There is phenomenal growth in e-commerce and e-banking transactions due to the expansion of internet. The role of banks has evolved within the international financial system due to the contribution of innovation in financial products, regulatory reforms, information technology advancement and phenomenal growth in international trade. Financial intermediation is the main function of a bank. It involves 2 aspects, that is procurement of funds and uses of funds. An international bank can procure short-term funds by way of short-term borrowing and short-term deposits from other banks. Deposit, borrowing by means of negotiable certificates of deposit, borrowing from parent unit or subsidiaries of the parent, non-bank deposits and also interbank and intra-bank deposits and also interbank and intra-bank transfers. Long-term funds are procured by the banks through the issue of equity shares and bonds. Funds are used by the banks through interbank and intra-bank lending, financing of foreign trade, loans to foreign government and loans to domestic and foreign companies and their subsidiaries. Deposits. The small portion of deposits of international banks is formed by non-bank depositors, that is corporate bodies and the government, and the largest portion is formed through interbank transfers. This is due to the fact that banks often deposit their short period excess cash balance with other banks. Deposit management by banks helps in ensuring continuity of the flow of the funds and at negligible cost, stability in deposit base, and benefits from mismatch of interest rates and maturity. Eurobanks and offshore banking sectors do not need to make cash reserve ratio deposit with host country central bank, as they are not subjected to any regulations regarding deposits. Still, as a precautionary measure, international banks do maintain a reserve balance like the domestic banks. Such balances are maintained with either domestic banks or parent banks and come in the form of non-interest bearing demand deposits. The international banks do not attribute much significance to these demand deposits as the balance is very small. But these international banks do manage time deposits with maturities varying between 1 day and 7 years. The deposits can be broken untimely if demanded, with some deduction in the rate of interest. International banks do not have captive deposit base, as there is lack of large demand deposits. Like domestic banks, international banks also issue negotiable certificates of deposit for the purpose of borrowing or accepting deposits. These certificates were firstly issued in 1960s by Eurobanks to attract huge amount of funds. There are various forms of certificate of deposit. 1. Tap certificate of a deposit. These CDs are issued by the banks in fixed multiples regardless of the amount of funds needed by it at a particular point of time. 2. Tranche certificate of deposit. That is, smaller banks generally issue these CDs as their need for funds is limited. Tranche CDs are issued in smaller denomination in successive installments. 3. Forward certificate of a deposit. Forward CDs are issued at a fixed interest rate and at a given future date. Lending. For lending, the agreements of loan of international bank normally do not include restrictive covenants such as ratio limits, dividend restrictions, and interest coverage. The main reason for this is that there is a large competition among international banks due to no restrictions on bank entry in the international money market or euro currency market. Different banks of different origins try to attract the same customer. In loan agreement, international banks apply the clauses in conformation with the practice and policy of the parent organization. In order to entice the customers, they do not apply restrictive clauses in the loan agreement. The customers are always preferred to go in the bank of their own country. For example, an American firm always prefers to approach an American bank. These banks offer loan on appropriate terms to allure the other customers. A loan from an international bank available to a subsidiary of a company should not be viewed in isolation of the company's entire network. For example, if a branch of a Japanese bank gives loan to a Japanese subsidiary located in India, then it should consider the relation between the two parent companies while giving such a loan. Any default may spoil their relationship in Japan. International bank offers both short-term and long-term loans. It also offers medium-term loan for a period of 1 to 5 years. Rate of interest. The interest rate specified by the banks differ from each other depending upon creditworthiness of the bank, customer, maturity structure of deposits, deposits liquidity, and the currency in which deposits are made. The interest rate of deposits made in a particular currency is determined by the forward premium or discount of that currency. This in turn affected by the expected future value of that currency. The interest rate of a currency with forward premium is high as it is more in demand in comparison to the currency with forward discount. But in foreign exchange or financial market, a currency can be converted into another currency using different techniques. That's why interest rate of different currencies tends to be equal. In international banking, deposit rate is influenced by the lending rate. This lending rate is the arithmetic average of interest rate determined by the 6 major banks in London at which they are willing to deposit or lending to one another in the forenoon of a particular day. This is known as London Interbank Offer Rate or LIBOR. Across the world, banks use LIBOR as the benchmark for setting short-term interest rates. In practice, lending rate is equal to the sum of LIBOR, that is LIBOR, and spread, which is contractually determined and ranges between 0.75% and 3.0%. It depends on various factors such as conditions of market, borrowers' creditworthiness, and maturity structure. If the credit market conditions are not tight, borrower is creditworthy or maturity period of loan is shorter, then spread will be lower. Otherwise, spread will be larger. The lending and deposit rates of domestic banks influence these rates of international banks by fixing up a floor and a ceiling for their rates. A customer will make deposit in international bank only when its deposit rate is higher than in the domestic banks. It will take loan from international banks only when its lending rate is lower than the domestic banks. In this case, it is assumed that domestic banks can compete with the international bank. International bank offers high deposit rate because they are not required to follow statutory reserve requirements and also do not come under the domestic regulations. On the other hand, these banks charge lower lending rate due to wide spread of their banking activities in a large number of countries that minimize the lending risk. These banks can operate on a narrow margin between the lending and deposit rates. Banks charge higher interest rate on medium-term loans in comparison to short-term loan. This is because of longer maturity and commitment fee that is charged on undisbursed loan amount. If the medium-term loan is syndicated loan, then lead manager charges management fees and agency fee. There is difference between spread and fee. Spread is charges over the duration of the loan and fee is paid at the front end. Loan syndication. When the specific amount of loan is lended by a group of banks, such credit facility is known as loan syndication. In loan syndication, banks are divided into 3 categories, namely lead banks, managing banks, and participating banks. There is a separate group called co-managers. In the process, a particular bank, that is a lead bank, is selected by the borrowers based on their relationship with that bank. After obtaining the mandate from the borrower for the loan, lead bank creates and organizes the management group. Lead bank then prepares a placement memorandum which contains the complete information on the borrower, loan terms and conditions and the proposed loan agreement. A proportion of loan is then contributed by the participating banks. The large share of the loan is expected to be provided by the lead bank. Once the group of managing banks is established by the lead bank, then it commits the group to raise funds on specified terms and conditions for the borrower. Marketing of loan is a primary responsibility of the lead bank, although it can take assistance from the other members of the managing group. In order to find the participants, methods which are generally used are: 1. A particular bank is selected by the borrower to participate in the loan syndication. This method is used if the borrower desires to create a relationship with that bank. 2. Participants are invited by the lead bank to join the syndication. Each major bank maintains the record of other banks with regard to their syndicated leading activities and then selects a bank according to its own choice from the list. Syndicated loan is a type of term loan in which borrower can draw down the funds within a specified time period of the loan being signed. This is known as drawn down period. Subsequently, repayments of loan are made according to an amortization schedule. Repeat. Syndicated loan is a type of term loan in which borrower can draw down the funds within a specified time period of the loan being signed. This is known as drawn down period. Subsequently, repayments of loans are made according to an amortization schedule. Sometimes term loan do not require any amortization schedule and all repayments are made on maturity. Such type of loan is known as bullet loan. Loan in which repayments are made according to an amortization schedule and also on maturity, a final principal payment is made are termed as balloon payment loan. The period previous to the beginning of repayment is known as the grace period. The length of grace period is also decided by the borrower and the lead bank. Charges on syndicated loans. Front-end fees and occasionally an agent annual fee are incurred in the process of loan syndication. Front-end management fees are negotiated in advance and imposed on the signing of the loan agreement. These fees are generally within the limit of 0.5% to 1% of the loan value. The borrower has to pay higher fees if he insists to obtain funds at lower spread than warranted by the conditions of the market and creditworthiness. It is very hard to quantify the relationship between spread and fees, but some studies show that banks charge higher fees if they are offering lower spread. Quoting spreads in syndication. Market conditions heavily influences the spread and maturities of the syndicated loan. When the conditions of the market are easy, spread decreases and maturities become lengthier. On the other hand, when conditions of the market are tight, spread increases and maturities become shorter. While quoting spread in syndicated loan, a number of factors need to be considered, which are: 1. The present level of rate of interest. 2. The bank's capital / asset ratios. 3. Interest rate volatility. 4. Risk of borrowers. 5. Pressures of relative loan demand in domestic market. 6. Changes in the competitive structure of the syndicated credit market. There is an inverse relationship between nominal interest rate and absolute spread. If the nominal interest rate is high, the absolute spread will be narrower. Interest rate depends upon the rate of return on capital, which the banks always try to increase. There are many reasons why an inverse relationship exists between nominal interest rate and spreads. One reason is that if borrowers are responsive to the total interest cost on syndicated loan, within bracket LIBOR plus spread, then its demand would be plummeted, which forced the banks to lower the spreads in order to compensate for higher LIBOR. Another reason is that the banks are expected to balance the marginal cost of all sources of funds. When the nominal interest rate is high, then reserve requirements opportunity cost is also higher. This widens the absolute differential between domestic market and euro market interest rates because the latter has no reserve requirements. This leads to shifting of funds into the euro markets, and also due to no change in demand for funds, spread would reduce. Procedure of loan syndication in India. The following steps are required to be followed in the process of loan syndication. Firstly, the borrowing company works out its investment proposal along with detailed financial plans and obtains approval from the government for both. The plans are approved in such a way that borrower is left with some flexibility. For the overseas constituent of the financial plan, the borrower invites quotations from major domestic banks and leading foreign banks. The borrower then gives mandate to the bank which provides best quotation and overall terms. The selected bank then prepares a document to be examined by a set of banks which are associated as managing banks. Discount is known as placement memorandum, which includes detailed information about the project which requires the loan, project viability, cash flow, and other relevant details. The main purpose of this document is to make interest of a large number of euro banks in the loan proposal. The selected bank then marketed the loan to a large number of participating banks. Even after this, the task is not taken to be granted, as banks might not wish to provide their funds and time if the project does not seem to be attractive. Once the required commitments are received from group members and the syndicate group is created, the lead bank creates the required documents and company officials sign them. The bank then distributes the funds to the borrower as per the agreed terms. We shall now throw some light on the advantages and disadvantages of loan syndication. International lending offers some advantages and disadvantages to the banks. The advantages are: 1. Many large banks have been finding international loans more profitable, as it had impacted their earnings significantly. Such banks include Citicorp, Bank of America, and Manhattan. 2. Banks can diversify international loans on the basis of country and also on the basis of customer. This helps them in improving their risk-return performance. Third, developing countries would be able to maintain high credit standing with international banks. 4. International lending risk has reduced due to the adoption of various safeguards such as credit insurance programs in the lender's own countries, guarantees by parent companies with respect to loan to its affiliates, and also guarantees by host government. The disadvantages are: 1. The analysis of country risk is very complicated as the behavior of the variables on which it depends cannot be precisely predicted. Recently, international bankers did not anticipate substantial increase in country risk. 2. Relaxation in credit standards is required by the banks in order to compensate for weak domestic and commercial demand for loans. 3. Many loans are short-term variable loans, which make it difficult for the debtor countries to service their external debts. 4. It is important for the borrowing countries to meet their obligations on time, otherwise the loan will be rolled over by the banks indefinitely. Fifthly, sometimes loans are required to finance the deficits in the balance of payments. Such loans do not raise the debtor country capacity to generate earning in foreign exchange. Summary. Banks are becoming more international due to the widespread of multinational corporations across the globe. The main function of international bank is financial intermediation, which involves two aspects, that is procurement of funds and uses of funds. The deposits of international banks are formed by non-bank depositors, that is corporate bodies and government, and through interbank transfers. International banks are not subjected to any regulations regarding deposits, but as a precautionary measure, they do maintain a reserve balance. Certificates of deposit are of different types, like tap certificate of deposit, tranche certificate of deposit, and forward certificate of deposit. Due to large competition among international banks, they do not include restrictive covenants in loan agreement. International banks offer short-term, medium-term, and long-term loans. LIBOR, that is LIBOR, is the arithmetic average of interest rate determined by the 6 major banks in London at which they are willing to deposit or lending to one another in the forenoon of a particular day. LIBOR is used as a benchmark for setting short-term interest rate. International banks offer high deposit rate and charge lower lending rate. When a group of banks lend a large amount of loan, such facility is known as loan syndication. In loan syndication, 3 categories of banks are involved, namely lead bank, managing bank, and participating bank. Front-end fees and occasionally an agent annual fee are incurred in the process of loan syndication. An inverse relationship exists between nominal interest rate and spread. If nominal interest rate is higher, then absolute spread will be narrower and vice versa. International lending offers many advantages and disadvantages to the banks.